Hello and a warm welcome to Econoday Unplugged on Wednesday, 16th of June 2021. Mark Pender's stateside, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London, where temperatures today have been on par with Cairo, which is nice, but not quite so great when you don't have any air conditioning. Okay, so where are we then? Well, inflation around the world is still going up, but central banks seem to have won over investor sentiment and bond yields pretty well everywhere, well below where they were at the time of our last global podcast in May. And that despite heavy supply and some significant upside surprises in the inflation reports themselves, all of which means that real yields are going through the floor. Even the Greek 5-year yield went negative for the first time earlier this week. So it's all good news for borrowers, of course, but do the economic fundamentals still justify such highly accommodative monetary conditions, or is now the time that the central banks should start to talk about tapering? Well, the June FOMC meeting finished a short while ago. So first off, let's find out from Mark if there's been any change of tune there after inflation hit 5% last week and a near 13-year high. So over to you, Mr. Pender. What did the FOMC have to say?
It is certainly not time to, it's too early to talk about tapering. So, interesting. That Jerome Powell in his press conference offered these kind of anecdotal, intuitive arguments, ideas about inflation as well as employment. But on inflation, he makes the point that he concedes that inflation, as you were mentioning, is above expectations, is certainly above Econoday's consensus ranges in a lot of these differing separate reports, including import and export prices today. But he says, but he's turning to the details behind the headlines. That's actually the wording he uses. That's something that our kind of talk. And he cited lumber prices as an example, saying that they had spiked earlier, but then due to supply constraints, long delivery delays, those issues, but then they have come down. And then he moved over to used cars, which have been in the U.S. Like a third of these readings are because of used cars, which he didn't talk about, or he didn't mention. He said he called it a perfect storm of strong demand, along with supply constraints. But a lot of that strong demand is from all the Federal Reserve payments and lengthened unemployment claims, for instance, and also lack of new cars, which are supply constraints. And he said, even though these prices haven't receded and they're through the roof, he says, they eventually will. And though the exact, when is uncertain. That was his point. So he drew on these, that it will be temporary. So they stuck to the transitory, temporary spike in inflation. Now, I don't know how convincing that is, but those are his. That's what they were discussing at the meeting, and the meeting also included the quarterly economic projections.
So what have they done with the inflation numbers? Come on, be honest.
Well, they just spiked for this year. They went up. Let me see here. I can't even see. Anyway, but it's like from 3.5% to 4.5% or something for this year. Actually, I could probably call that up on my Econoday calendar here. Give me just 1 second, and I'll get those numbers for you. But then they're virtually unchanged in 22 and 2022 and 23. So those inflation readings. Went from 3.4% at now in the June forecast or quarterly from 2.4% in March. But then the ones next year and the year after that are virtually unchanged, right at just fractionally above the 2% target line, and the same with the core rate.
So in other words, what we can say is the Fed is more than happy because this fits in with their idea of adopting this average inflation targeting. So you get the pullback this year, which makes up at least partially for some of the undershooting in the past, and thereafter you're on target. So everything's actually nice and sweet at home.
It falls right within their framework, exactly. But will it fall back into their framework? And then the questions at the press conference on inflation expectations. We just had one today from the Atlanta Fed on the year ahead business expectations, and they never say anything at the Atlanta Fed about their data, hardly at all, and they just put basically the numbers out. But they put this line in there that this is a significant increase, 2/10 to 3%. Doesn't sound like a lot, but for their sample, this business sample, that's the most they've had in about 10 years of records. In fact, the last 2 months before that, 2.8 and 2.6, I believe, those were also records. So this is shooting through the roof. So this is that, the lumber idea, or, that Powell is suggesting that then this will be temporary and that it'll come back. And so, and then he used, it's kind of a self-reflexive circular argument awake, because then he points to the FOMC projections and as well as offering some kind of evidence that inflation expectations are temporary. Well, because those projections are coming back, and that's what he expects. Everything will come back. But it was also interesting, Jeremy, because we do the Econoday Consensus Divergence Index tracking these forecasters, and he had a little bit about how difficult it is for these, the life of a forecaster, Anyway,
did he talk much about upside? Sorry, did he talk much about upside risks to inflation and sort of concede that we might get it wrong and it might sort of surprise us on the upside?
He didn't concede that as a significant risk, but he did say if we do get it wrong, then we'll stick to our mandate and we'll pull things back. We'll begin tapering, and I guess, and that's where that reference came in a question on tapering. But so, he did say that they would, use their tools as part of, because their mandate, employment's one part of their mandate, and maintaining stability in prices the other. And if it gets out of whack and it looks like it's going to be run away, he said they would taper. So, but that's not what he's expecting.
Can I ask you about the dot plot? I mean, I know people love or they hate these dot plot things, but they do give you some kind of idea about, when the members think that interest rates may be going up. So has that changed at all? Is there any idea that perhaps rates may go up a little bit higher than they thought at the last FOMC, or is that unchanged?
That's everything is basically unchanged. I can again, using my Econoday calendar, get this information for you in just a second. The exact forecasts for those, and here I am. And there's let's see here. Out on to 2003, there is a one notch higher risk for or outlook for a 0.5 point increase. So that is higher, but that's 2 years out. There's no change for the next 2 years. So that is one thing, and that does contrast with the economic projections to an incremental degree.
Okay, interesting stuff. Anything else from your side? 'Cause I know you've got a lot of scribbling to do today.
Yeah, well, employment. Powell also talked about employment, and again, he gave these anecdotal explanations, on how to look at employment and why is it so slow. He conceded that, and that's what we've been talking about. Really, the last two employment reports of the U.S. have fallen in the low end, if not completely collapsed, below expectations. But there's still growth, and then he started saying, well, it takes time to find a new job, and we all knew that lead times for staffing is long. And then he said, there's still a lot of people who are concerned about COVID, and that they don't want the public-facing jobs yet, and related to that is childcare, keeping your kids safe. But both of these, the first one should ease as vaccinations improve, and the second one will ease when schools reopen in the fall, and also the scaling down of the emergency unemployment benefits over the next few months. So he says, over the next few months, after sometime in the fall, we should start seeing an acceleration in the jobs market. But in any case, I'd just like to underscore the anecdotal quality. It's almost like reading a business survey. Like, what do you like? what do you think about employment? And, and the 18 members, I guess I'll, talked about this, jotted down in their business contacts, and he offered these as, the main things. I mean, this is not hardcore, number crunching or anything like that. So, but it's, but as it's kind of flying by the seat of your pants. But I guess they have no other choice, especially a time like this when all the models have been thrown out the window. So, but it basically, I think, for the markets and for the investors, is that the Fed is going to be patient, and they want to see the numbers, and that's another important reason to read Econoday, because that data dependency was very critical in his press conference today. And they're not going to taper, they're not going to do anything until they see some kind of sustained numbers. Now, right now, it can go through the roof, and they've already prepared us for that. Anyway, so keep track of your Econoday calendar.
Okay, great. Thanks for that, Mark. And talking of numbers, Southern Hemisphere time, Bran, China. We've had some slightly disappointing industrial production and retail sales figures for April coming out. Inflation's still on the way up, though. So kind of how's the mix going on in that part of the world?
Well, I mean, first of all, China's not in the Southern Hemisphere, as I'm sure you're aware, Jeremy.
Sorry,
but that's okay.
Sorry. So I meant to say you in the Southern Hemisphere, but yes, quite correctly put. Thank you.
No, but in this time zone, shall we say? So we did have the China numbers yesterday, and I think what we're seeing here is just sort of the flow-on effect from all the volatility in the year-over-year numbers. So I think just try to abstract from that if we can. Obviously, all the year-over-year numbers are comparing to very unusual levels 12 months earlier in the immediate impact of the COVID pandemic. The year-over-year numbers have come off a bit from where they were a couple of months ago, but that's probably just returning to sort of more normal growth rates. If we look at the month-over-month numbers, which we tend not to with the Chinese data, because we're not too sure about the seasonal adjustment and other factors, that they've been the last couple of months positive, reasonably solid, nothing too concerning there. So I think we're just sort of getting back to normal, I think, in most of the Chinese numbers. And that's also the case with the PMI survey, not indicating, I think, that growth is super strong, but also not seeing any downturn resuming.
Okay, in terms of China, there's been certainly some stuff in the media of late about the COVID outbreak in the Guangdong province, and potential disruptions to the sort of global container shipping industry and so on. At a time when we got all these supply chain dislocations anyway. Do you think this is going to be important, or is it something which can get over quite quickly?
That's obviously a big part of the regional trade network. So it's something that we need to keep an eye on. But at the end of the day, there is probably scope for them to work around it and still keep trade happening. So it's just a case of continuing to monitor whatever anecdotal reports we can get about this, and then seeing if it flows through to the actual numbers that we do track on Econoday. So looking at most of the trade reports from the region, you can still see areas of weakness, but again, it's hidden to a certain extent just by the very big year-over-year changes that we do see in some of the numbers. For instance, we had Japanese trade data this week, some large year-over-year numbers because of we're comparing with a low base 12 months earlier. But in general, I think what's happening across the region is that we're seeing some countries do a bit better than other countries, mainly reflecting what's going on with the local COVID situation. So I think India and Japan are two of the economies in the region where they have had some serious COVID problems in the last few months, and that's having a real impact. But elsewhere in the region, you look at as I said, China, Hong Kong, Singapore, Australia, the growth numbers, the activity numbers have been better.
Okay, and in terms of when you look at these PMIs, almost, well, one, I suppose the sort of key components now that certainly people in Europe are looking at are these vendor delivery times, which have been going through the roof in a number of Eurozone states, indeed UK as well. But delivery times are, are reaching all-time record highs. Is that true in your part of the world as well?
Yeah, well, I don't know if they're record highs, but yeah, that is definitely something that a lot of survey respondents have been citing, and you are seeing it in the PMI numbers. And hopefully that is something that can come down, because that obviously a lot of the production in this part of the world is closely dependent on each other as well. So if you have a problem in one part of the region, then that quickly flows through to elsewhere, and can really restrict their ability to get production moving again.
Okay, thanks for that.
But just before we do go,
no, I'm not letting you off yet.
Okay, fair enough. Move on.
No, unless you want to stick with China, I was going to move on to Australia.
Okay, sure.
In the context of the policy and stuff, a lot of these central banks at the moment appear to be looking perhaps more at labour market reports than they are at inflation, on the grounds that inflation is going to go up and it's going to come down again, so don't worry about it. You've got your labour market report for May due shortly. Is the labour market still kind of the kingpin for the RBA, or are they now becoming more focused on what's happening to prices?
No, I think you're right. I think it's still very much focusing on the labour market. The RBA for a couple of months now have been saying, look, we do expect to see a bit of a spike in near-term inflation. Again, partly just related to that sort of base effects from 12 months ago. But they've given every indication that they think it will be temporary, and underlying inflation will move back down later in the year, and then through 2022 as well. Won't pick up too strongly. So, and the reason they do think that overall price pressures, underlying price pressures, aren't going to be too serious is because we're just not seeing it in wage growth at the moment. We are seeing a stronger labour market, and things are picking up there, and hopefully we'll see more of that later in the week. But wage growth, the main measure of wage growth, is still very subdued, and so for that reason, they are, similar to the Fed, not really talking about any major move in policy for the foreseeable future. They've been very explicit that they're not just going to wait for inflation forecasts to pick up. They want to see the actual numbers pick up on a sustained basis before they start to move. And so now there's a lot of people are pointing to some of the stronger numbers out there in Australia, and saying, okay, the RBA has to think about it, but they're not showing any signs at the moment. We do have the RBA governor speaking just in a couple of hours, actually, where he might provide a bit more context and detail about what they're thinking. But they've also just highlighted the July meeting, so in just over 2 weeks, as a really key one for them to talk about what the game plan is going forward. They've basically said, at the July meeting, we'll talk about whether we'll continue our program of government bond purchases. We'll update all our forecasts and see where we think inflation will be over the next couple of years, and we'll also talk about whether we shift the government bond that we use for our target yield. There's some suggestion that they might move that forward another maturity, in which case they might be thinking of leaving policy on hold for longer, or they might just keep it where it is, in which case they might be thinking of, okay, we can start to raise policy rates maybe early 2024 rather than late 2024.
So this could be the key to tapering, or a leading indicator of potential tapering or shifting policy.
Yeah, that's what I think. So once we get the statement for the July meeting, we should have a lot more information about what they're thinking, and that's obviously based on they're probably crunching the numbers right now to update their economic forecasts.
Okay, key date for the diary. I've got to ask you, being a Brit, obviously, Boris Johnson over here has been jumping up and down, getting awfully excited because they've just announced a UK-Australia trade deal. Now, I mean, for the UK, exports to Australia are worth about just over 1% of total UK export markets. How's it sort of gone down your side in a nutshell?
I mean, I don't think it's a game changer for Australia as well in terms of the share of the UK. It's a piece in the puzzle. It's a good step, and there's also opportunities, I think, for people to work in the UK and for Brits to come down to Australia as well. So that's I think they're planning to make that a bit easier. So that's also seen as a positive development. But I guess hopefully that will also just give a bit of momentum for the UK to make some more trade deals with other important trading partners, and perhaps it will provide opportunities for Australia as well.
I guess I send a similar sort of note, I suppose, since I know it's ridiculous, but people in my part of the world always tend to regard Australia and New Zealand as being a little bit similar, at least, if only because of the accents. Does this have any implications for a potential, perhaps, trade deal between the UK and New Zealand as well, or is that something completely different?
I mean, I don't think it necessarily paves the way for that, but I guess if New Zealand sees that Australia is able to do it, then they would hopefully see that as an opportunity for them to say, we're also available and we can do something on similar terms. So I think that's obviously an issue for the New Zealand government to try and take the same sort of opportunities as the Australian government is, because I would say probably, I'm not sure about off the top of my head, but I would think perhaps that the UK is a more important trading partner, relatively speaking, for New Zealand.
Okay, interesting. So just quickly sticking with New Zealand, you've got I think the first quarter GDP numbers are due later on today. You had a first quarter contraction. A fourth quarter contraction. What's expected for the first quarter? Is it a rebound, avoid technical recession, or are you going to join the recession club? Or New Zealand would join the recession club, I should say.
Yeah, I think they've generally been okay in recent months. Obviously they've got the COVID situation under control there, so I think the forecast is for a small. Yeah, I'm just looking at the forecast now. It's a small quarter-over-quarter increase, and so avoiding the technical recession. And I think the RBNZ is in a similar position to the RBA in that they do see some near-term price pressures, but no hurry to move on policy because they think that the underlying price pressures are still pretty contained.
Okay, excellent. Anything else you want to put into the bucket from your part of the world?
No, I just think policy in general in this part of the world is on hold for the time being. We've got the Bank of Japan later this week. Mm-hmm. I can't quite remember when the RBI will next be meeting, but I think in those cases, Japan, India, no sort of prospect of major changes either, just because they're also dealing with some sort of weak growth numbers at the moment. And so Australia probably, not just because I'm sitting in Australia, but I think Australia is probably the canary in the coal mine in this part of the world in terms of seeing where the policy outlook is going. So just stressing that this July meeting by the RBA is going to be closely watched, and stay tuned.
Okay, excellent. Thanks for that, Brian. So to my part of the world, then, I'm really just following on the same sort of theme that Brian was talking about. There's no obvious indication that we'll be seeing any kind of major policy changes coming out of Europe either. ECB meeting last week then, well, there was no change in, pretty well anything there. The key there was always going to be whether or not the central bank would decide to unwind all or at least some of the 20 billion euro hike introduced in the pandemic emergency purchase program, its main QE weapon that it announced in March, which was only supposed to last through the second quarter. As it was, it decided it wasn't going to do anything at all. So it's still, by the looks of it, going to maintain that level of purchases through the third quarter. So kind of, if you read between the lines, what it all comes down to, although the ECB is suggesting that the risks to the economy are kind of less on the downside now, they're more balanced, particularly over the medium term. But they are clearly still concerned about the prospects for the economic recovery. And indeed, crucially, still see, like so many other central banks, rising inflation, which we do have at the moment. Inflation's actually finally moved back above target, has only been temporary. So it probably means, as far as the ECB is concerned anyway, expect nothing really of any significance out of them now until we get the September meeting, when they'll have to say what they're going to do about pet purchases once we move into the fourth quarter. And will we then see some tapering, or is it the case of more of the same? So as Brian was saying with the RBA, there's a few dates in the diary which could be quite significant as far as monetary policy is concerned. In terms of the numbers out of Europe, well, there's not really too much to add on what we were saying. I guess we're saying last week. We've had some more April data through, some of which were quite good, some of which were pretty poor, but they continue to be badly impacted by the effects of COVID, because we still had lockdowns in place in a number of Eurozone states in that month. But May is still, by and large, at least the survey data is suggesting that it should be a pretty decent pickup coming through then, and more to come in June. So it does still look currently, at least, as if the second quarter for the Eurozone should be a pretty decent period. That said, just quickly going back to these global supply chain disruptions, the EFO guys out of Germany, they produce a regular business sentiment survey, which is one of the more closely watched indicators coming out of the Eurozone. They revised down their economic forecast today for 2021 growth in Germany. That's been reduced to 3.3% from 3.7%. So it's still, in normal terms, a decent number, but given what happened last year, probably somewhat disappointing. And really, it is due to the fact that a number of German producers are having major problems now getting sufficient raw materials, notably in the auto industry, to produce their final products. And indeed, if you look at the IP numbers, industrial production figures, they've fallen in 3 of the last 4 months. So I mentioned, Germany key still the best part of 30% or so of the Eurozone. So although things are still looking pretty good there, there's still some reasons for caution about just how quickly this recovery is going to be delivered. And that's obviously going to be instrumental in terms of what the ECB does from here further out. UK wise, well, it's kind of good news and some hints of bad here as well. Most of the numbers for the UK have been very strong of late, and there's every reason, it seems, for expecting a particularly strong second quarter GDP number. But, and it remains to be seen how big a but it is, but the Delta variant for the coronavirus, the one which originated in India, that's been estimated by at least UK scientists now to be at least 60% more transmissible than the Alpha variant one, the original UK one. And now they reckon that the best part of 90% or so of new COVID cases in the UK are from the Delta strain. Now, these cases have actually started to increase significantly. So, well, you don't have to go back very long ago when new COVID cases in the UK were down below 2,000 a day. They're now running at over 9,000 of the latest figures. And because of that, the government has decided to delay what people were calling Freedom Day, when the intention was to relax all the remaining restrictions on social mixing. That's been delayed from 21st of June to at least July the 19th. Now, that doesn't mean to say that come July the 19th, we won't see the economy fully reopening, but it does mean that over the next 4 weeks or so, best part of the next 4 weeks or so, the expected rebound in growth won't be as strong as it would have been otherwise, because the likes of the hospitality and particularly the travel sector, which has been hit really hard, will continue to struggle, and so it's going to slow the rate of growth. Also of importance, I think it's worth mentioning that despite the fact the government's decided to delay the reopening, they're not going to offer any additional economic support. So there's going to be no additional extension of the furlough, or indeed, it seems at this stage anyway, any other kind of additional funds for the struggling companies. So it's kind of good news at the moment in the sense the economy is doing well, but there's still this wary eye about what's going on with the coronavirus. On the inflation front, I should mention UK numbers consistent with, I suppose, what we're seeing elsewhere in the world at the moment. They were surprisingly strong. We had them out earlier on today for May. Inflation in the UK, they're moving up to 2.1% on a headline basis. So that's the first time we've seen it above target on over a couple of years or so now. And indeed, the core rate as well, that was up to 2%, so bang in line with target for a similar sort of time. So it does seem that inflationary pressures in the UK, like a lot of Europe, is picking up. But at the same time, we've got to say that in line with what Brian was saying about his part of the world, the central banks within Europe, including the ECB, Bank of England, and indeed the Swiss National Bank, we'll talk a little bit about them in a minute. They'll be meeting tomorrow on Thursday. They still seem to be adhering to this view that any kind of increase we get in inflation at the moment will be only temporary. So it will come back down again towards target, and hence there's no need to rush into any kind of what they would see as a premature tightening. Now, regards to the Swiss National Bank, worth mentioning them, I suppose, just because they've been steady for so long, and inflation is gradually moving up there, but it's still ridiculously low. It's only just crept above the 0% mark, running at 0.6% at the moment. So it's still nowhere near the kind of pseudo 2% target that they actually operate with. But they still getting very concerned about performance of the currency. As we've talked about before on the podcast, Swiss National Bank policy tends to be geared more and more towards at least semi-targeting the currency. And since the last meeting, we did have a period during which the Swiss franc started to weaken quite significantly, and the Swiss National Bank was very happy about that. But of late, it seems, because the economic numbers have been very good, and indeed, if you take some of the leading indicators at face value, Swiss second quarter GDP could be extremely strong. It seems to have led some additional capital inflows going into the Swiss franc. And so that's led to renewed upward pressure on the franc, and it's forced the Swiss National Bank to intervene quite aggressively. And indeed, the intervention we've seen over, at least part of May anyway, and almost moving into June, has been some of the biggest sales we've seen by the central bank of the Swiss franc since, the last 6 months or so, something like that. So it does still suggest that the currency remains particularly important as far as the Swiss Monetary Authority is concerned. And they still want to see inflation accelerate towards this called near 2% mark. So again, another central bank, which for the time being at least, notwithstanding strong real side economic data, appears to have no intention of doing anything in terms of interest rates. From my side, I'll quickly round off with Canada, again from the inflation front, and just I suppose just telling the same sort of story. We saw a big increase coming through in inflation in terms of the April data. The May data we had today, and that showed another increase in inflation. So year on year, consumer prices in Canada were running at 3.4% in April. That's now up to 3.6%. So well above the Bank of Canada's 2% midpoint target. And again, what's the Bank of Canada going to do? Well, the message coming out of them currently is still, just like all these other central banks, it's going to be temporary, it's base effects, it's part COVID related, it's due to a number of one-off factors, it'll be coming back down again soon. But a bit like the FOMC, you kind of wonder how far above target can inflation go before these central banks have to do something. Now, the Bank of Canada has already tapered policy twice over the course of the last 6 or 7 months or so. And there's going to be speculation after today's inflation numbers that they may decide to do some additional tapering once we get to the next meeting in July. Now, whether they're going to do that or not at this stage, I must say, is a bit of an open question, which may not be particularly helpful for people wanting an answer. But we have had indications of a fairly sharp slowdown in economic growth, indeed, probably negative growth as far as the April is concerned, April GDP. And that reflects the fact that the COVID numbers out there started moving up somewhat later than we had in the States or what we saw in Europe. So there's a bit of a lag involved there. Abstracting from that, though, I guess you've got to say, if you're looking for a central bank which is more likely to tighten than pretty well any other one at the moment, then it's still most likely to be the BOC. But I think from what everyone's been saying, Mark, Brian, and myself, for the time being at least, don't really expect these central banks to be doing too much anytime soon. Okay,
among those central banks, among the central banks you do look at, Jeremy, though, which one do you think is the one that's most interesting to just really pay attention to at the moment?
Do you know what? I mean, not because I sit just outside London, but I think I might say the Bank of England. I mean, they've been plugging the lines with, talked about, inflation goes up, but don't panic, it's coming back down again, so nothing to worry about. Now, there's still the big issue about what happens to the economy once they pull out this furlough scheme, the support scheme for the labour market. And they clearly are concerned about that. But it does seem that unless the Delta variant really messes up the recovery, what we're seeing in the economic data is surprisingly strong. The inflation numbers today we saw were well above, I'm sure, what the Bank of England were anticipating. And they did warn inflation is going to go above target. I don't think they expect anything like they got today. So if we see another big number coming through in the June figures, then I think we'll start to see them tapering properly quite soon. And it may be we see interest rates going up next year. So I think the B of E now is starting to, or should be starting to, get onto the centre of people's radars as being, a major central bank, which is more likely perhaps to move on rates, before any other. With, I must say, the Bank of Canada perhaps being the other. Let me turn it back to you just before we wrap this up and we prattle on for too long as usual. Your part of the world, who do you think, ignoring quantitative easing, who's going to put interest rates up first?
It could be Australia. They have been very clear that they think it's going to be on hold for quite some time. But then I think if you look right across the region as well, there's not a lot of appetite for any moves elsewhere as well. So the thing about Australia is that perhaps if we do see the labour market finally start to put upward pressure on wages, then that would really change the RBA's mind pretty quickly. The other issue to be aware of in Australia, though, is also housing prices. Just with the low level of rates here, there has been pretty strong gains in house prices over the last 6 to 12 months, and that is starting to catch the attention of the RBA. At the moment, they're just sort of making noises about how important it is to keep lending standards high, and thinking about other things that you could do to sort of curb excess enthusiasm in the housing market. But if they got the green light from the labour market to sort of dial things back a bit in terms of policy, then I think they would be keen to do that.
Okay,
2024 is a long time away, so who knows what could happen between now and then.
Too right. I was going to end it there, but since you mentioned the housing market, without wishing to run this on for too long, I know the Reserve Bank of New Zealand, they're shortly going to be imposing, I think, was it debt-to-income ratios with a view to cooling down the housing market out there. Do you think the RBA would do something similar, or do they not go down that route?
They haven't in the past, but they haven't done a lot of things in the past that they're doing now. So that is an option, and I think they have shown a willingness to try different policy tools in the last year or so, and that could be something that they decide if they see the wages are still very subdued, but house prices are ramping up, then that is something they could think about.
Okay. You say lots of central banks having to do all sorts of things they're not used to doing. Okay, then. Thanks, Brian. Well, let's wrap it up there then. On behalf of Mark, Brian, and myself, thanks as ever for listening. Podcast will be back as usual next week. And in the meantime, as you all know, you can find all the key market moving data and events listed and analysed in Econoday's global economic calendar. Bye for now.